Well, thank you for joining me at this week's weekly update. If you have questions for the future, I want to make sure to send them right here. The market's feeling messy. Should we be expecting a correction? What do we mean by messy? Well, this question is a bit of a amalgamation of several questions we're getting from clients. Just a few weeks ago, we had our market outlook. We talked about very positive growth numbers. We thought there was a 20% chance of a recession, but overall things look pretty stable. We were more cautious on the market. We thought valuations were relatively high. Now it seems like the concentration of the market issues we talked about are front and center. There was a whole year there where it seems like all we got was positive headlines, but now we're talking about market concentration. We're talking about high forward price to earnings levels. We're talking about an economy that got a report that was growing much slower than expected by most economists in the fourth quarter. It looks like a lot of that ended up being due to the government shutdown in October, almost a full percentage point is what it looks like. But more to the point, you saw some weakness there. You've got some weakness in the AI story. You're talking a lot about private credit and maybe how overexposed it is to AI, which is, by the way, one of the reasons you want to be very careful about who you invest with when you talk about private credit. But the AI story itself is becoming a little bit more questionable. People are wondering how quickly some of these things are going to change. OpenAI's CEO got some bad news from one of their major chip suppliers saying they were going to make a much smaller investment than was expected. They also talked about a $1.4 trillion build out just a few weeks ago from now until 2030. And recently they updated that number to 600 billion. 600 billion is a lot of money, but that's an $800 billion change. To put that in perspective, the U.S. economy, U.S. manufacturing, according to the St. Louis Fed, is about $230 billion a year. And then the next 4-year number that one company was going to spend just shrank by 800 billion. So people are starting to call some of these things into question. How positive is this over time? Are there a lot of fear out there? Well, it seems like we're getting a few more negative headlines. We got royals around tariffs. Seemed like that was kind of settled and kind of going generally downward, and then the Supreme Court overturned the tariffs as they stood, and we got a new set of tariffs. So, what are we expecting here going forward? We think overall the economy looks pretty good, but are we expecting a correction? The answer, and I'm not trying to be funny, is yeah. Yeah, of course we are. We've shown charts year after year. On average, you have about a 14% correction in the market. So should we expect some sort of pullback sometime this year? Yes. Last year, we had double-digit returns in the S&P 500. We had a 19% intra-year correction. People have already seemed to have forgotten that. But if you look at this chart, when valuations are high, what's the odds of a correction or a pullback? 5% pullback, 99% of the time. 10% pullback, 83% of the time. 15% pullback, 53% of the time. 20% pullback, about 29% of the time. There's a 4 out of 5 chance that we see a 10% pullback or greater this year. So yes, we're expecting a correction. I also expect it to snow in Wisconsin sometime this year. I mean, it's part of what we're expecting. If there's a fundamental underlying change to the economy and the system on a 5-year outlook basis, that's a great reason to make big changes. But otherwise, right now, what you really want to talk about is discipline. This is a great time from an allocation standpoint to be disciplined. If over the last couple of years you had decided on a 50-50 portfolio, that was your risk tolerance and your risk capacity, and through no fault of your own and maybe trying to avoid some taxes, that's grown and now it's a 60-40 portfolio. I can tell you there's 2 ways to fix it. You do it yourself, or you let the market do it and ride out the next nasty correction back to 50-50. I can tell you which way is more fun, and I can tell you which way you lose less money. Now is the time to be disciplined. Even if there's future further upside, it's always important to be disciplined, right? You don't want to be overly fearful and you don't want to be overly greedy. It's about being disciplined. So are we expecting a correction this year? Yeah. The 10% correction seems like it's almost inevitable at 4 to 5 times, right? When is it going to happen? How quickly is it going to happen? That's much more difficult to call. But even last year, there was only a couple week period that if you didn't get it just right, you basically might as well not have timed it at all and just wrote it out. And that's typically the better solution. Trying to time the market is really a good way to make even just one mistake, either when you sell or when you buy, and miss out on a whole lot of returns. So you want to try to do what you can not to time the market. And that's what I think people are really asking when they're asking if we see a correction coming is, should we be timing the market? No, we shouldn't be timing the market. Are we expecting a correction? Yes. Can there be fundamental changes we make over time? Yes, but this is the time to be disciplined. And when the market goes down, and maybe that 50-50 portfolio we readjusted to is suddenly 45-55, it's a great time to buy back in, even though that'll be the time where it's most fearful and it's probably the most difficult thing to do. But it's about being disciplined over time. With that, I'm going to leave you here. Last week for this, easy money. Go ahead and watch our review here. Thanks everybody for joining me ever so much, and I hope everyone has a great weekend.